Hey guys, it's time to wind down. Tonight, we'll gently step back into 1961, a year when Warren Buffett was still in his early 30s, quietly building something extraordinary. We're not here to chase stock tips. We're here for something gentler, a few thoughts, a little wisdom, and maybe a sense of peace. If you enjoy this kind of quiet space, feel free to like and subscribe, but only if it feels right to you. Let me know in the comments where you're tuning in from and what time it is right now. It's always amazing to see this little community coming together from across time zones. So take a breath, turn down the lights, and let's begin. Tonight, let's softly walk through how we performed in 1961. I have consistently told partners that it is my expectation and hope, though sometimes it's hard to tell which is which, that we will do relatively well compared to the general market during down or quiet times. However, in advancing markets, I expect we may not shine as brightly when the market strongly advances. It is truly challenging to keep pace. Now, 1961 was indeed a good year for the general market. More than that, it was a very good year for us, both absolutely and relatively. Still, the hopes and expectations I just shared remain the same. During 1961, the general market measured by the Dow Jones Industrial Average, or simply the Dow, showed an overall gain of 22.2%. including dividends received from owning the Dow stocks. Over the past 5 years, we have carefully managed several partnerships, starting with just 3 in 1957 and growing to 7 by 1961. Each year, the gains shown here are after expenses, but before any distributions to partners. Looking at the big picture, the cumulative growth of these partnerships has been impressive. Starting in 1957, the partnerships earned a gain of just over 10%, which was exactly in line with the Dow that year. By the end of 1958, the combined gains had grown to more than 55%, significantly outperforming the Dow's return of about 41%. This strong momentum continued, and by the end of 1959, the partnerships had nearly doubled in value, with gains close to 96%. In comparison, the Dow had experienced a smaller gain of about 26% during this same period. Moving forward to 1960, the partnership's cumulative gain rose to nearly 141%. Although the Dow's cumulative gain slowed to around 23%. Interestingly, this year the partnerships slightly underperformed the Dow, with a difference of just over 6%. However, by the end of 1961, the partnerships had achieved a remarkable cumulative gain of 251%, more than doubling the Dow's cumulative gain of approximately 46%. This resulted in an advantage of about 22 percentage points over the Dow's performance during these 5 years. In simple terms, despite some ups and downs along the way, these partnerships have consistently outpaced the general market over this period, providing solid growth to those involved. Please remember, these results do not measure the gain to the limited partner, which is of course the figure you are most interested in. Because of the different partnership arrangements we have had in the past, I have used the overall net gain to the partnership based on market values at the beginning and end of the year as the fairest measure of overall performance. If we adjust these results to reflect how gains would have been shared under the current Buffett Partnership Limited agreement, the picture looks like this. For the limited partners, the yearly gains began at about 9.3% in 1957. In 1958, their gains rose substantially to just over 32%, reflecting strong growth. Though 1959 saw a more modest gain of nearly 21%, the gains in 1960 were still solid at around 18.6%. Then, in 1961, the limited partners enjoyed a very healthy gain of almost 36%. Looking at the compounded growth over time, these gains add up impressively. By the end of 1958, the compounded gain for limited partners reached 44.5%. By 1959, this figure grew to nearly 75%, and by 1960, it exceeded 107%, more than doubling their original investment. By 1961, the compounded gain was a remarkable 181.6%, almost tripling the starting value. In comparison, the Dow's cumulative gain over this same period was about 22.2%. This means that limited partners' returns under the Buffett partnership arrangement significantly outperformed the general market. The most important factor in my choice of partners and in my relationship with them has been the agreement that we use the same yardstick. If my performance is poor, I expect partners to withdraw, and I should look for a new place to invest my own funds. If performance is good, I am confident of doing well, and I can adjust happily to that reality. The challenge, then, is making sure we all agree on what is good and what is poor. I believe in setting these yardsticks before the fact. Looking back, almost anything can be made to look good compared to something else. I have continuously used the Dow Jones Industrial Average as a measure of par. I feel that 3 years is the minimum test of performance, and the best test is a period of at least that length where the Dow's ending level is reasonably close to its starting level. While the Dow is not perfect, nothing is. It has the advantages of being widely known, having a long history, and reflecting reasonably accurately the experience of general investors. I have no objection to using other measures of market performance, such as other stock averages, leading mutual stock funds, or Bancommon trust funds. You might feel that my yardstick is too short or too simple. Just bidding an unmanaged index of 30 leading stocks might seem easy. Actually, this index has proven to be a tough competitor over time. Arthur Wissenberger's classic book on investment companies lists the performance of all leading mutual funds from 1946 to 1960. Currently, over $20 billion is invested in mutual funds, representing the experience of many millions of investors. Though I can't get the exact figures, I believe portfolios of leading investment advisors and bank trust departments have had results similar to these mutual funds. Wissenberger lists 70 funds with continuous records since 1946. Now, let's gently walk through a bit of comparison. From a universe of 70 mutual funds with continuous records from 1946, I excluded 32 included balanced funds and specialized industry funds, which didn't fully ride the wave of the general market. Notably, 18 of those 32 still underperformed the Dow. So the exclusion wasn't meant to tilt the findings of the remaining 38 funds. The ones that could be reasonably compared to the Dow, 32 underperformed. Only 6 managed to do better, and even then, only slightly. These 6 funds represented about $1 billion in assets. The other 32, over $6.5 billion. None of the better performing funds beat the Dow by more than a few percentage points annually. Let's take a peaceful moment to look at how 4 major funds performed over these years. These include the 2 largest open-end investment companies, Mass, Investment Trust, and Investor Stock, and 2 of the largest closed-end funds, Lehman and Tricontinental. In 1957, the year was challenging for most, with these funds experiencing declines. Massachusetts Investment Trust fell by 12%, Investor Stock by about 12.4%, Lehman by 11.4%, and Tricontinental by 2.4%. The Dow declined by 8.4% that year as well. In contrast, our limited partners saw a gain of 9.3%, a positive return amidst a difficult market. The following year, 1958, brought recovery and growth. Massachusetts Investment Trust rose by 44.1%, Investor Stock by 47.6%, Lehman by 40.8%, and Tricontinental by 33.2%. The Dow's gain was 38.5%, while our limited partners achieved a solid 32.2%. In 1959, growth slowed somewhat, but most funds still showed modest gains. Massachusetts Investment Trusts increased by 8.2%, Investor Stock by 10.3%, Lehman by 8.1%, and Tricontinental by 8.4%. The Dow rose by 19.9%, and our limited partners did even better with a gain of 20.9%. In 1960, the market was mostly flat or slightly down. Massachusetts Investment Trust declined by 0.9%, Investor Stock by 0.1%, while Lehman and Tricontinental posted small gains of 2.6% and 2.8%. The Dow declined 6.3%, but our limited partners enjoyed a healthy gain of 18.6%. When compounded over multiple years, the comparison becomes even more striking. While many funds trailed the Dow, our limited partners experienced a much higher rate of return. Again, I don't present these numbers to criticize mutual funds. If I were responsible for managing large pools of money under similar restrictions, I doubt my results would be better, possibly not even as good. I share this to highlight that the Dow isn't an easy opponent. Most funds, collectively representing millions of investors, have found it hard to keep pace with it now. Let's take a calm stroll through the way we invest. Our operations fall into three gentle streams. First, the generous. These are undervalued companies where we have no influence and no fixed time frame. This has been our most fruitful field over the years. We usually make significant commitments to a handful of these, and they often take time to appreciate. Sometimes they surprise us with quick gains, but often we must be patient. These aren't the glamorous stocks that get attention. That's precisely why we can buy them at lovely bargain prices, offering a margin of safety that brings comfort. We are not after every last dollar. We are content to sell at a fair middle ground when it feels right. Still, because they often move in sync with the market, they can drop just as steeply in rough times. But over the years, I believe they'll outshine the Dow. Second, the walkouts. These are different. Their returns rely not on market whims, but on corporate actions, mergers, liquidations, spin-offs. They come with a built-in clock. Because of that predictability, we can manage risk more easily, and we often use borrowed money cautiously to enhance returns. Over time, this category has been a steady second in terms of gains. These investments usually yield 10% to 20%, excluding any leverage benefits. And third, our control situations. These are the rare cases where we own enough of a company to influence its direction. They may take years to bear fruit, and often, the best strategy is to patiently accumulate shares at low prices. Once in control, we gently nudge the company toward a better future. Let me now share one such story, softly told. Dempster Mill Manufacturing Company, a company based in Beatrice, Nebraska. We first bought shares 5 years ago as a general undervalued play. Then a lot became available, and I joined the board. In 1961, we gained majority control. It wasn't a quick operation nor on most of us. At year's end, we held 70% of Dempster's stock. The market for its shares was thin, and we couldn't rely on quoted prices. So, We had to estimate its value carefully and fairly for those joining or leaving the partnership. At the time, Dempster had sales of about $9 million and a book value around $75 per share. We conservatively valued our stake at $35 per share. Though our average purchase price was only $28, this holding made up 21% of our net assets. Dempster hadn't shown much profit, mainly due to management issues and tough industry conditions. But we saw potential. If we can restore even modest earnings, its value should climb. Control investments like this don't rise just because the market does. In a booming year, they may seem sluggish, but they offer something deeper kind of insulation from market excesses. They, along with workouts, help protect us. Lastly, let's reflect on a gentle question. What does it mean to be conservative? Many once believed that holding long-term bonds was the safest route. Then came inflation. Today, some feel buying blue chips at any price is safe. But without the benefit of hindsight, such decisions can quietly lead to danger. True conservatism. In my view, there's nothing truly conservative about trying to guess how far an eager and unpredictable public might push up the price-to-earnings ratio. You aren't correct simply because many people agree with you in the moment. Nor are you right just because powerful or respected individuals agree with your thinking. And yet, in many circles, the presence of these two factors, public enthusiasm and expert approval, is enough to label something as conservative. But real conservatism, I believe, rests on a foundation of knowledge and careful thought. Over the long run, through many decisions, you are only right if your assumptions are sound, your facts are correct, and your reasoning holds up. That now. Just because our investments may not appear conventional does not automatically mean they are more or less conservative than traditional approaches. That judgment can only be made by looking closely either at the methods used or at the actual results. To me, one of the most meaningful ways to evaluate our conservatism is to look at how we perform when the market declines, particularly when the drop is significant. In the modest downturns of 1960, our results support the idea that we invest in a very conservative manner. I'm more than open to any partner suggesting other objective tests of conservatism. I'd welcome the opportunity to compare. To date, we've never experienced a realized loss greater than half of 1% of our total net assets. And our realized gains, in dollar terms, outweigh realized losses by a ratio of about 100 to 1. Of course, this does reflect that we've mostly been in a rising market. Still, even in such markets, opportunities to make mistakes and suffer losses are plentiful, as you may have found yourselves. So I do think our track record here is meaningful. The question of set aside from questions about what happens when I pass away are topic that, in a curious way, I do think about quite a bit. The most common one I get is this: what effect will the partnership's rapid growth have on performance? Larger funds can pull us in two directions. For investments, where we take a passive role where we're not trying to influence the company, having more money to invest can be a disadvantage. When you're buying stock in widely traded companies like General Motors, there's only a slight difference between purchasing 100 shares and 10,000 shares. But with the kinds of securities we often work with, buying in larger amounts can be far more challenging and sometimes simply not possible. So yes, for a portion of our portfolio, bigger funds can hurt performance. For most of our workouts and some of our general investments, I'd say the disadvantage is only slight. But there's a third category: control situations where having more capital is a clear advantage. A sunbone map type investment can't be done without significant resources. And in fact, I believe the opportunities in this area grow as our capital grows. That's because competition drops off steeply as the size of the required investment increases. Also, the larger the company, the more likely it is that no single owner controls a big enough stake to influence decisions. That creates space for us. Which factor wins out, the limitations in passive investments or the advantages in control investments? Honestly, it depends on the kind of market we're in. For now, I believe they balance each other out. If that changes, I'll let you know. But I can say with confidence that our 1960 and 1961 results wouldn't have been better had we stayed small, like we were in 1956 or 1957. A prediction: those of you who read past letters might be surprised I'm venturing into the realm of predictions. It's something I usually avoid and still do, in the traditional sense. I have no idea what business or the market will do in the next year or two. But over the next decade, I feel fairly confident we'll see some years when the market gains 20 to 25%, some when it loses about the same, and most years somewhere in between. The sequence of these moves, I haven't a clue. And honestly, for a long-term investor, I don't think that really matters. Over the years, I believe the Dow will likely return somewhere between 5% and 7% annually, through a combination of dividends and capital appreciation. Anyone expecting more on a consistent basis may be setting themselves up for disappointment. Our goal isn't to beat the market every single year. It's to consistently outpace the Dow over time without stressing too much about whether we're up or down in a specific year. In fact, I'd consider a year where we're down 15% while the Dow is down 25%. To be a better outcome than one where both the partnership and the Dow are up 20%. I've emphasized this in conversations with many of you, and while heads often nod, it's important to me that this idea resonates not just in your mind but in your gut. Because of the way we invest, our biggest advantages are likely to come in flat or declining markets. There will be years when the Dow does better than us. But if, over the long run, we averaged 10 percentage points better annually, I'll consider that a success. To be specific, if the market falls 35 to 40% in a year-end, I believe there's a good chance it will in at least one of the next 10 we aim to be down only 15 to 20%. In a flat year, we hope to be up about 10 percentage points. If the market rises more than 20%, we'll try to keep pace, though that's not where we shine. If the Dow ends up compounding at 5 to 7% per year, I would hope we might achieve 15 to 17%. That may sound bold, and viewed from 1965 or 1970, I may be proven wrong. Still, I want to share this outlook with you. Even knowing the risks of forecasting, miscellaneous were now comfortably settled into our office at 810 Kuwait Plaza. I'm fortunate to have Beth Hanley, a first-class secretary, and Bill Scott, an associate with solid experience in the kind of investments we pursue. My father is also here, sharing both the space and the costs, though he runs a separate brokerage business. None of our trading goes through him, so there's no conflict of interest. I expect our overhead excluding borrowing costs and taxes to stay below 0.5% of our net assets. I believe that's money well spent. And of course, you're warmly invited to visit and see how it's being used. As of early 1962, we have more than 90 patents and about 40 different securities in the portfolio. Our net assets have grown to $7,178,500. Susie and I personally hold a $1,025,000 stake, and other family members together hold $782,600. Last year, the minimum for new partners was $25,000. I'm considering raising it this year. Pete, Marwick, Mitchell & Company did a wonderful job with our audit faster and more efficient than in the past, and They've assured me this level of service will continue. As always, please don't hesitate to reach out with any questions about this letter, your audit, or your investment. I'm happy to help. Cordially, Warren Buffett. Let Buffett's calm voice echo into your sleep. You don't need to know all the answers tonight. You just need to stay curious and kind to your future self. Good night, and see you next time when we return to another year, another letter, and more quiet thoughts from Warren Buffett.